On then, our special series London Eye kicks off today. CNBC TV18's Udayan Mukherjee caught up with Russell Napier of Eric and began by asking him what he made of Janet Yellen's statements and if he felt that she was indicating that the Fed cannot afford to raise rates.
What Janet Yellen knows that we know, but where she has a little bit of added information, is some of the degrees of distress in the global financial system, particularly in the emerging markets. So she's obviously several times in the last couple of years pulled back from doing anything. I think what pulls her back is actually discussions with Christine Lagarde. I don't think that's often commented upon, but it's Christine Lagarde who ultimately sees the distress in the system. There are a lot of people at the IMF looking for assistance. Now, rising US rates, potentially strong dollar, is the last thing that kind of edifice needs at the minute. So I think that's the reason she pulls back, more than anything that's happening domestically. In fact, if you look at her speech, the reasons she was pulling back, actually most of them related to things that were happening well outside the boundaries of the United States of America. She specifically raised China, and she specifically raised Brexit. So it is interesting just to what extent international affairs are having an impact on her behaviour.
Equity markets be happy then? Because there seems almost every time she pulls back there's a rapture. But on the other hand, equity markets, should they be worried?
I think it should be the other way around. I mean, the history of this is if the Fed starts raising rates from very low levels because growth is accelerating or above expectations, that equity markets would not react negatively to that. A sign of higher growth and higher inflation is good for equity markets. Now, there's a limit to that, but I would say the limit in terms of inflation would be a level above 4%. Certainly historically, the equity market would tend to go up as long as inflation is trending upwards, but not hitting 4. And if US rates are going up at the same time, it's not a negative for the equity market. Now, we're still quite a long way before we get to 4% US inflation. So I'm confused because I look at it the other way around. I look at the failure to raise rates as the most frightening thing out there. Because if this economy is an economy heading towards recession, there's very little monetary ammunition left. So I took last Friday's figure as something truly dreadful for global equities. And the global transmission mechanism is the impact it has on America's external accounts. If America's not going to grow as fast and its current account deficit isn't going to get bigger, then the emerging markets have got some serious, serious problems. And yet they all went up. There was a relief rally because the dollar came down and US rates aren't going up. So I think the markets are wrong on this.
The problem is markets react like this, and contrary to what you're saying, they remain wrong for some period of time. But how do you time this thing? Because longer term, it looks like the trouble is brewing and it's building up. But we are in the midst of a 2-3 month rally out there.
The simple answer might be it's impossible to time this thing. I mean, I think there's a nice quote from Warren Buffett. He says investment is simple but not easy, which is very accurately sums it up. The way to make it easier is to have a longer term time horizon, and the more we get into second guessing short term gyrations in the market, the more we're likely to be wrong. So I know it's not advice that you can necessarily give the professional investor who is paid for activity, but certainly if anybody's watching this who's a private investor, it pays handsome dividends to take a longer term view and not try to time this. What you do is you build up a series of indicators that tell you which way it's going, and you watch those indicators. And if you have a view, but if those indicators go the wrong way and you're wrong, then you'll have to change your mind. My view at the minute is the world is still heading towards deflation and not inflation. And I don't see the evidence to change my mind on that. And in terms of short-term timing, I think we just have to all intents and purposes, ignore it.
You think markets are ahead of themselves then?
I do absolutely think they're ahead of themselves. I think monetary policy. Why are we where we are today from 2009? Well, it's because of monetary policy. But is it succeeding? And what is the definition of success? To me, the definition of success on their own terms would be to have nominal GDP growing faster than debt, de-gear the global system, which the general consensus is that the reason we got into this mess is we were over-geared in 2007. Well, the global system is more geared today as a percentage of GDP than it was in 2007, so they failed. Now, if central banking fails, we're going to have another remedy, and that remedy is fairly excessive active government action. I don't see how that can be good for return on capital employed for the equity market in particular. So the market is still of a view that central bankers will get us there eventually, and therefore you hold on. But if they're wrong on that, then we get something which I think will be bad for equity markets, and the poster child would be Japan, where I think it's becoming clearer by the day that monetary policy in isolation does not have the solution. So we may be close to a final realization at what happens when monetary policy in isolation fails.
What would convince you, or what would convince policymakers in the West that that experiment is not working out?
Well, the easy thing is a recession. I mean, if the jobs number last week is a precursor for a recession, that's the first obvious thing. You've got to imagine that you are the President of the United States, and you look around the room, you're in a recession, towards the end of this year, you look around the room for advice, you're probably not going to take a lot of advice from the central banker. You're probably going to say, well, you've been doing this since 2009 and it's not working. You're probably going to look around the rest of the table. And if you're President Clinton, who knows who might be at the rest of the table? You could have Paul Krugman at the table, you never know. Larry Summers will be at the table, and we all know what Larry Summers would like to do, and that's much more government action, much more fiscal spending. So there's going to be a shift to that coming along. Why I don't fear fiscal spending for the market, but what I do fear, and particularly for Japan, is this combination of fiscal and monetary policy, which is on Mr. Ben Bernanke's list of things you do to defeat deflation. And I think it'll come to Japan first. I think the actual problem with the next step is it doesn't come in unison. Prime Minister Abe 2 weeks ago was trying to persuade everybody we need to do this in unison. And in unison, I think it would work and it would be inflationary. But done unilaterally by one government, I think Japan, it's not reflationary. It has a major dislocative effect on exchange rates. So I think Abe was trying to persuade everybody to do it and he failed. So one of the things I'm looking at is that failure, what does it mean? And I think the temptation for Abe to go unilaterally on this policy is going to become overwhelming. And the more the yen goes up, the more that is the case. And the impact on the yen would be pretty drastic, I think, if Abe is the first person to go to this, what was called helicopter money, which is the fusion of fiscal and monetary policy. So I think imminent for Japan, but the democratic process, or the nature of the logjam in the democratic process in both the United States and Europe suggests it's not imminent there.
Okay, music to your ears if you are a bear. So quite pessimistic, Russell Napier. Deflation is something that he's kept talking about. In fact, wants a rate hike because that should, according to him, give some confidence to the markets. Otherwise, he believes that there's a good chance of a recession as well. And jobs number could be a precursor to that. But that's one bearish view. Let's move on. Ashwini.